So guys, sorry. So guys, on to the next one. Last time I did a video. The last YouTube video I did was on the intermediate lecture. So we covered pips, we covered leverage and all that. So we'll be moving through into the advanced lessons. So we'll be talking about liquidity, types of analysis, understanding the candlesticks, market condition, trading sessions, support and resistance, chart patterns, and types of traders. So for this part, actually, we need to be taking notes as I'll be explaining from this guide that I've already sent out to you. If you don't want to take notes, you can still while watching the video, you can still refer to this guide so as to give you a better understanding. So, moving on, I will be using this guide also to guide myself as I teach you guys. Okay, advanced part one. So, at this point, I believe that you now have a clear understanding of how the forex markets work, like the the basic mechanism of the forex markets, how the price charts move. So moving on to liquidity. So what's liquidity? Liquidity in the forex market is actually it just means money. That's like the simplest description of liquidity. So you might see a lot of traders on Instagram or maybe on YouTube who claim they are smart money traders. I actually did smart money trading. That was like a few months back or if like a year back. I dabbled into that and I actually call myself a smart money trader. So these traders actually claim that they trade with the banks. So they enter when the banks are entering and they exit when the banks are exiting and they are hunting other people's stop losses. So in a sense it actually sounds true that that's what they're doing because of the way they pin their chart and all of that. Sorry about that. But I can tell you that no one actually trades like the banks. The banks don't trade like us. So all those analogies are just fake, just to draw a lot of people to that to that trading style, and it's working for them. So liquidity actually means money. So once you hear that a market is liquid, what it actually means is that there is enough money, there's enough activity going through in that market. So let's say Euro USD. For example, Euro USD is like the most liquid pair in the world. That's why the spreads on Euro USD are like the smallest spread. Euro USD and GBP USD they have like the smallest spread ever in forex trading. So any pair that is very liquid, okay, any pair that is very liquid, we have a very tight spread on every broker, no matter the broker, no matter the type of broker you're using, you have a tight spread. So liquidity actually volatility is different from liquidity. So a pair can be very volatile but have less liquidity. Let's take BTC as an example. BTC is very volatile, but the liquidity in BTC is not that much. It's actually driven by it's mostly driven not by liquidity but by market speculation and news. Okay, for example, let's say Elon Musk comes out and says um, he is now planning to accept BTC as a payment option to buy your Tesla cars. And you see BTC starts running up. Okay, it will start going up because of that news. So what happens is that people start reacting to that news and thereby driving the price of liquidity, price of Bitcoin up. But in the sense of Euro USD, GBP USD, the liquidity generated in those markets come from the banks itself. They come from the banks, and it's traded. like is the liquidity is pegged between two institutions. So once euro is converted to USD, once USD is converted to euro, that's what generated the liquidity. That's why it's very easy. This is the like the most easiest pair to trade. Euro USD and GBP USD. So for new traders, those are the pairs that are recommended to start up your trading business, your Euro USD and GBP USD, because they are cool to trade. They are cool to trade. Okay. So factors that affect liquidity. Okay, let's say liquidity spectrum. This liquidity spectrum exists. Okay, liquidity exists on a spectrum ranging from high liquid assets to low illiquid or low liquid assets. So as I mentioned, high liquid assets and low liquid assets. I mentioned BTC, I mentioned GBP and USD. So highly liquid assets can be bought or sold quickly with minimum price impact. So you get that you can buy them and sell them quickly with minimum price impact, while illiquid assets may require more time and effort to execute, and a trade can result in a significant price change. So you can see that trading BTC can take a lot to execute. That's why the spread are too wide, because it takes a lot for the brokers to facilitate a trade on BTC. Wise on Euro USD, GBP USD, there are basically almost no spreads, because it's just like you just a snap of finger and your trade is executed. Okay, so factors that affects liquidity are trading volume. Okay, more activities. Once you have more activity, more financial institution dealing on a particular instrument. That's where you have volume in it. So that's where you have liquidity, because money is being pumped into that market. Also, market participants. So, okay, like I just mentioned now, if you have a lot of institutions that are dealing on that particular pair, that's when liquidity comes in. Also, trading hours. So, here, trading hours can be is related to the time the banks open. So, if during the course of this session, we get into forex trading hours, sessions. So what that means is also it's almost the same thing here. So trade market hours, the market hour. This is actually the time the banks for a particular currency pair is active. So let's use GBP for example. You know GBP is pounds and the US dollar. So when GBP is mostly active is when um, banks in England are open. Okay, you know England has the same time zone as us. So immediately it's eight in the morning. That's when our banks open. Immediately it's 8 in the morning. That's also the same time when banks in England, in UK open. So you can see if you check your charts at that particular time, you can see that GBP will always move. Okay, there will be liquidity in that market. There will be money pumped into that market. And then also because especially with the USD, the banks in the US, their 8 a.m. is around 2 p.m. in our own time. And now you can see out during 2 p.m. in our own time, our banks are still open. So the banks in the UK are still open. Then you now have banks in the US also open. So these two, the liquidity that comes from these two banks, they collide. So you can see if you check your chart by 8:30, that's why most times news release, the high impact news that affects any pair always comes out around 2 p.m. 2 p.m. Nigerian time. That's when the US markets open, the US banks open, and you always see a lot of liquidity coming to the market at that particular time. Okay. So moving on, news events, like I just said, the time that news events come out, that's when you see a lot of liquidity. News events always come out during New York section. That's US section open. So that's when all the most effective economic news gets released. Some gets released during London Open, but then they are quite rare to come around. But the main ones always come around on US session. Okay. Then you have depth of markets, liquidity providers and market makers, impacts. So then you have the impacts of spread. So like I said, if a market is not liquid enough, the spread are bound to widen. Okay. So also when you see liquidity leaving the market is during the closing hours of the day. So if you check your charts around 10 in the night, okay, 10 in the night, just from within 10 in 10 p.m. in the night to 11, just check your MT4 and check your spread. You see how wide the spreads are. Why? Because the US market is closed. The London or UK markets are closed. So there's no liquidity, no active participants in the market, and you can see that the spread comes back to normal once it's 11 o'clock. Once it's 11 o'clock, it comes back to normal because that's when Asian markets open. So they pump a little bit of liquidity into that. So let's move on. Okay, you have asset class. Okay, you can read through that. Let's move on. Types of analysis. So in forex market, we have a few types of analysis that traders can look into depending on the trading style they want. So in forex trading, traders use various types of analysis to make informed decision about buying and selling currency pairs. This analysis can be broadly categorized into three main types. So there are three main types of analysis. There are also other types, but the three main ones are fundamental analysis, technical analysis, and sentiment analysis. So fundamental analysis, this is actually trading the news. So you're just waiting for economic news release. So I actually did show you this. Okay, as you progress in this material, you actually see where I posted this. So this is economic calendar. Okay, so these are high impact news. So I actually set this and filtered it to only high impact news. So if you are using the just filter it to only high impact news because other ones will just be they just they just clog your this thing and they are not of any effect. So these are news that will actually affect the market. Okay, so today is Friday, 6th October. We actually have NFP. NFP is one of the most volatile news release in the forex market. So we have NFP today. So throughout this week, we've been having news release. So you can see this 8:30, 10 a.m., 8:15, 10, 11 a.m., 10. So these are all New York time. So during this time, this is when the liquidity comes in. That's why these news are being released at this particular time. Okay, so traders who make use of this fundamental analysis, who use them as their own strategy. Okay, as you can see, this is what I was talking about. Who use them as their own strategy. They make use of this news release calendar. This is Forest Factory. So they make use of it and they always wait for this any day that they have this news release, and then they will try to capitalize on the news. Immediately the news comes out, they try to capitalize. But I'll tell you, trying to use this method is very dangerous. It's very, very dangerous. You need a lot of experience to be able to trade the news. Remember what I said about the news and spread on our last lessons. So they also use economic indicators to analyze and trade. So maybe they will hear that the Bank of England is raising rates. The US market is having a big hit on this and that, on this and this and that, interest rates and all of that. So they will try to maybe let's say the UK is raising interest rates, and then US their unemployment rate is getting worse. So they can use that as a catalyst to buy GBPUSD because UK now, which controls the GBP, they are raising their interest rate. So that means people are saving more. Okay, people are saving more and spending less. Why the US economy is going down because of unemployment rates. These people try to buy GBPUSD on a long term perspective, not on a short time. Just you don't when you have economic factors like don't try to buy and make money in like a day or two. No, you buy this and hold trade for like a month, almost a month before you can make enough money from fundamental analysis, analytical trading. Okay, we also have political events. Let's say, for example, when what was that? Trump and Biden were, you know, going through their tug of war, whatever they were doing. It was actually affecting the market, so people can also capitalize on that. Okay, and you also have COVID during COVID. You also have during Ukraine war. Okay, during Ukraine war, if you check it out, you can see that a lot of pairs, like a lot of pairs which are safe for investors to save their money, like gold. Gold started running up. Gold ran up like up to, let's say, I think about 5,000 pips. That's a lot of money if you cut that on the low, at the lows. So, and you can also see other pairs like the US dollar getting weak, pound, Euro USD, all of them were dropping massively. Okay, and the yen pairs are going up. So all those pairs that are very good for investors to save money, they are going up because they are safe haven for them. And all those other pairs that are risk pairs. Okay, they were losing values because money were investors were pulling money out of those places. So these are the type of events that fundamental traders should look to capitalize on. Then we have technical analysis traders. This like the number one for everyone trading forex. If there are 100 people trading forex in the world, 99 are trading technical analysis. So this involves using charts, the charts like what you have here, the trading view charts. This involves using this to make trading decisions. Okay, so you learn how to analyze the chart, and then you can make your trading decisions based on the information that this chart have provided. So key components in this price chart, technical indicators. So you have a lot of indicators, okay, a lot of trading indicators that you can use. So let me give you this example. So if I go on my daily chart on this way, so I have, if you can see this line. Okay, that this line on my chart here, this is an indicator called a moving average. So for me, I use the moving average just to indicate trend. So once all these price, these candles are below the moving average, that means we are trending down. When they are above the moving average, we are trending up. Okay, so a lot of technical traders, they might just make use of this moving average, and they say to themselves, okay, once I see a moving price breaking and closing and staying below the moving average, that means we are bearish. So I'll continue selling. I'll just keep selling. I'll just keep selling. That sounds very easy, but it's not always easy. Okay, you just have to find the right balance. You can't just use one thing and have it work. One thing can't work. Okay, just have to find the balance between a few things and put them together to form a very good strategy that will work on the long run. Okay, so let's say you say to yourself that once price break above the moving average, I'll be buying because price is going up. Now you can see here, in a few places price broke below, so you can sell here and you can see price breaks above, and you can buy here, it breaks below again, you sell here, it breaks above again. So that's not a strong way of staying long in this market. You can use it also. You can use it also, but you have to find the right balance. You have to find a few more things to combine with this. It's just about building confluences in the market. Okay, just about building confluences. So that's for indicators. Okay, indicators. Then you have chart patterns. We actually discuss about chart patterns as we move forward. We have support and resistance level. We also discuss about that. We have then, so the purpose, technical analysis is often used for short-term trading. So you can see that it's used for short-term trading only. Unlike fundamental analysis that is only applied on long-term trading. This can be used for short-term trading. And okay, it's not short-term trading only. You can use technical analysis for short-term and also long-term trading, because you can use the chart is fractal. what that means is what actually happens in a 5 minute chat can still happen on a daily chart. So if you have a module that works on the 5 minute chart, you can still um, lay that out on a daily chart. But the difference is that it takes a lot more time, a lot of time for these things to play out. Okay, it takes a lot of time for you to get an entry. You know, it takes like week. It might take like weeks, months before you get an entry. Whereas on the 5 minute time frame, it might take like 30 minutes before you get an entry, 15 minutes, an hour before you get an entry. So it depends on the trading style you want to apply to your trading. So moving on to the next topic, understanding the Japanese candlesticks. So these Japanese candlesticks, they are the holy grail of forex trading, of the what's that, fundamental and technical analysis. Sorry. So all these black things here are actually Japanese candlesticks. So I actually set my own black. It's not actually, you can change to any color you want. Let's say this for blue. I'll change this to blue. Okay. So that means any blue candle means candles that are going up, any black one going down. So I actually set this to black because I don't want any distraction. I just want to see price for what it is. Not if I see a blue candle, is blue is going up. If I see a black candle, is black is going down. No, I just want to see price action. Okay, so but it just depends on you what you want to use. You can use a black candle, or you can use blue, you can use red, you can use pink, you can anything. Just it depends on what you want to use. So okay, we're talking about speaking about indicators. I actually have another indicator. This is volume. So this is the amount of volume in each candle. So if I place this on this volume bar here, you can see this crosshair. You can see this small line that is going around with my cursor. So if I place this here, you can see the candle is actually line on. So this line will tell you the candle here. So you can see the amounts of volume in this candle. Here you can see the amount of volume in this candle. So some traders will also use volume as a big indicator of where they want the market to go. You just have to find out how it works by yourself. So understanding Japanese candlestick. So a Japanese candlestick is a type of price chart that shows the opening price, the closing price, the high price, and the low price points for each given period. So you have to understand this is for each given period. So let's go back to this chart again. So I am on a daily chart now. Okay, let me use monthly. Okay, let me apply let me use a new chart because I already have drawings on this. Let's say AUD this Australian dollar USD. I think this chart is clean. Okay, so let me delete if there's any drawing. There's no drawing. Okay, let's use a monthly chart. So this is actually the current month now. So you have 25 days and 12 hours left for this particular month to close. So it says here that this Japanese candlestick shows the open, close, high, and low points for each given period. So what applying that here, what it means is that this, if I'm on the monthly chart now, if you check here now, this you have a lot of time frames here. These are the ones that are already given by trading. So these are the ones you can use. To add any other time frame, you can still add seconds. You can still add seconds time frame, but they are not given by trading view. Why? Because you need to pay. You need to pay to get those ones. So if I check 30 seconds, I don't think it's okay. See, okay, yeah. You see, they tell you to upgrade. So if you want to use the 30 seconds charts, you have to upgrade to be able to get those features. But the ones here are the ones they have already given you. So you can use any of these apart from seconds. So if I put this on a monthly chart, this means what it means is that one single candle like this represents 1 month of price action. So it will take 1 month for this candle now to form and close before another one opens. So once we enter, okay, you can see this October 2nd. So look at the dates below. You can see this October 2nd. It started on October 2nd. This one is September 1st. This one is August 1st. This one is July 3rd. Okay, as if you keep going, you see the date as which this candle open. Okay, the date that we show below here is the day that this particular candle actually opens. And then the day that we show on this one is the day that this one closed and this one opened. Okay, this is actually a full month. It takes a full month to form. If I now change this, okay, let's use this line now and mark this one and also mark this one. So remember what I said. This October 3rd is when this one closed and this one opened. And this thing here, this September 1st, is when this one closed. Okay, this one closed a day before and this one opened on September 1st. So let's say from September 1st to October 2nd, if I go now to the weekly, okay, you can see now, this is the first week of the month. Okay, this is the first week of the month. So you can see now on the days there, you can see August 28th, Monday, August 28th. So this means that in this particular candle, we actually transition from August into September, because you can have, okay, these are weekly candles. So this means that each one takes a week to form. Okay, this one takes a week. This is a whole 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 week. And if you combine all of them, that forms all of them together will form this particular month. Okay, this particular month here. Okay, so if you see this from August 28th, that means this is actually a weekly candle transition. We transition from August to September. So let's say maybe as 28th August is Monday, around Thursday for that week, we entered September. So that's why if you check on the monthly time frame, this thing is actually September. But if you check on the weekly, the first candle here is August because it's transition within the week. If this particular week started on first, you actually see first below here where they wrote Monday 28th August 2023. Okay, so all this week now combined makes that monthly candle I did point out. So now if we go to this candle now, so this candle is a week candle, then this another week. So if we move down to the daily, okay, you can see daily. Here you have the first day of that week, second day of that week, third day, fourth day, fifth day of that week. So there are always 5 days in a week. In the trading week, there are 5 days. Okay, this you can see here, this is Monday, Tuesday, Wednesday, Thursday, Friday. And then this one Monday, Tuesday, Wednesday, Thursday, Friday. So the price action on these candles from Monday to Friday will determine how a single weekly candle will look like. As you can see, see as that weekly candle is looking now. So the shape of this candle will be determined by how the price action of Monday, Tuesday, Wednesday, Thursday, Friday happened. Then same transcribes to the daily. So let's say you have this day, this is the day we are in now, and you have the previous day. If you go down to the 4 hour chart, you can see here this is where the daily opened. Okay, 17 o'clock. 17 o'clock is when a new daily candle opened. That 17 o'clock is 11 o'clock midnight in Nigerian time. This is when a new daily candle opens. So this 4 hour chart now, this the first candle that's open, the first 4 hour candle that's open on that day. And this particular candle takes 4 hours. 4 hours to do everything it wants to do and close. And another one opens and runs for 4 hours, closes, another one open for 4 hours. And you can see we have one, two, three, four, five, six 4 hour candles in a day. So the behavior of these 4 hour candles say will determine how a daily bar will look like. So as you can see that this 4 hour candle, this it opened here from low, went up, went down, and still went up again and closed up and closed at this high, almost at this high. So now if you check this daily candle, you can see this daily candle open and closed here. So what this daily candle is going to show is just the average low and high of this particular day. But when you check in the 4 hour, when you check on the 4 hour, you can see it went up and went down and then went up again and closed at this high. But then the daily just show that it closed above, it's closed strongly. While the 4 hour, you can see a lot of things, a lot of price movement. Same as if you go down on a 1 hour time frame and you see this particular candle here now that opened from at this high and closed below. So let's check it. Okay, let's check it. If you go to the 1 hour, okay, you can see that particular candle now. This the open. So you can see at the 1 hour, it just open down, 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 and closed here. This is like 4 hours. One, two, three, four. That's 4 hours. Another one opened here. One, two, three, four. That's another 4 hour. This one opened here. One, two, three, four. Another 4 hour. Another 4 hour can open. One, two, three, four. 4 hour. So all these things, eh, 4 1 hour candles equals 1 4 hour candle. I think 6 4 hour candles equals one daily candle. Five daily candles because there are five trading days. That's Monday to Friday. Then on BTC, the BTC runs throughout the week, even weekend, Sunday, Saturday, Sunday. BTC is trading. So then five daily candles equals one weekly candle. Four weekly candles equals one monthly candles, and 12 monthly candles equals one 12 months candle, because there is also 12 months in 12 months candle. If you check here, you can see 12 months. This is actually a year worth of price action. So if you check that, you can see here on you can see 2021 was bearish, 2022 was bearish, 2023 was bearish. So we've been bearish for the past 3 years now on Aussie dollar. But on this smaller time frame, you can still see a lot of buy opportunities, a lot of sell opportunities, a lot of buy opportunities, a lot of sell opportunities. But overall, on the yearly time frame, overall, what is actually doing on the bigger time frame is that it's dropping, it's just going down, it's just going down, it's just going down. But within it, you can buy and sell, you can buy and sell. Okay, I hope I'm making myself clear. So now I believe that you have understand how these candles and their dates and their opening time and closing time works, and how they can transition from this to this. So now what I want to explain now is the bodies and the wicks. Okay, so this you can see now you have these bodies. So these bodies are the thick ones, are these thick ones, and then you have the wicks that are these small lines here. So as you can see now, this is a weekly chart. You can see that this thing has a body and they have a small wick above here, and also have a long wick below. What this means is that, okay, this is where this. Let me change this to blue so you can understand what I'm saying. So here, this one open. Okay, this one closed down, because this one went up. The blue ones means they went up. Like if they open there, they went up and closed up. And the black one means if as this one closed up, if it closes below the price that it opened at, it will turn black. And if it closes above the price that it opened at, it will turn blue. Okay, simple. So this thing now, this black one means that this weekly bar closed below the price that it opened at. So once it closes, the next bar will always open at that same price that the last one closed. And you can see now it's open there and it's below that price by a very large margin. So what this week here now means is that at a particular point in time, this huge black candle here that is actually here now was here before. It was below. It was at this low and started going back. Okay, and started moving back and it's now here. What this week at the top means is that when this candle opened at a particular point in time, it was at this high and it started coming back. So the body all we always move according to the opening price. So anything that happens away from the opening price, if it goes down away from the opening price and start coming back to that opening price, it will always leave this week. So this week is like a trail that shows, okay, if you see a snail now, a snail that is moving, a snail will always leave a trail. Okay, a trail that you can see that trail and trace it from there. From tracing it, you can know where the snail is. That's what this week is like. Okay, it got here and started going back. This week we tell you that at a particular point in time, price was here. So now if you go to, let me put this thing here. This is where the weekly started. So if you now go to the daily time frame, you can see what we have here now. Price opened, dropped, dropped, and start going up, and this is where it is now. So this drop now and this reversal, that price just reversed now. That's what is making this week on the weekly time frame. Until this, if this this weekly candle now has 11 hours, so today is Friday, it have 11 hours remaining. If it closes here now, this is where this candle will, that means this candle has done the same. It will remain like this forever on this chart. It will remain like this forever. So if you go back even to this, I think this chart started around 1988 or what, 1980 something. So if you check, you can see all those candles, they are still there. So this candle will remain like this forever until the forest market goes away. Same is applied on the daily time frame. So you can use what I just explained here on this weekly candle now to understand the daily time frame, the hourly time frame. The same thing here, the same thing I explained that happen even on the 1 second time frame, even on the 5 minute time frame, even on the 1 minute time frame, the same thing also happens. So if you check the 30 minutes time frame, you can see you still have candles that are doing the same thing. So the way it still happened on that daily time frame, this is the same way it will still happen on this 30 minutes time frame. So you see, open, this thing made this high here and came back to the opening price and closed below that opening. Okay, at some point it went below and then closed. This one closed below the price. This one closed below the price, closed below the price, closed below the price, and then closed above the price. So if you combine now 30 minutes, how many 30 minutes are in an hour? Two. So two of these candles here will make up 1 hour. So as you can see now, this candle now have 11 minutes left to close. So if you check here now, you can see this is 5:19. Okay, the 5:19 added 5:19 and you add 11 minutes to it. That to make it 30. So that means this thing now, this particular candle now is the first 30 minutes candle in a 1 hour candle. So if this candle closes and another one opens and closes, that will form a 1 hour candle. Then apply that to other ones. It's simple, a simple thing to calculate. So and you get used to it with time. Okay. Then going back to our lesson. So this everything I just explained there is also has been explained on this write up. So read through it. And then I placed a link here. So with this link you can use this and check up other candlestick formation. So these candlesticks, most of them, there are a lot of candlestick formation indicates indicates that price will go down or price will go up. So if I can explain a little thing here with this candlestick, looking at these candlesticks here now, this indicate the behavior of buyers and sellers in the market. That's what this candlestick indicates. The behaviors of buyers and sellers. This will tell you how the sellers reacted to this market and how the buyers reacted to this market. So let's use this candle now. You can see this small body on this candle. It's actually closed above the opening price, but the body is very small in relation to where it went before coming down. So this means that at some point this particular candle was as big as this one. Okay, as big as this one at some point, and then and it's closed down, and you can see how small the ball looks. So what this actually means is that when this candle opened, buyers stepped into the market. There were a lot of bids, a lot of bids were coming because this for this thing to go up from here to here, it just requires one single transaction. Okay, a single transaction between a seller selling his asset to a buyer to really buy. Once this transaction happens, price goes up. Okay, it just requires one single transaction for this thing to go up a huge amount of that. This thing now, this price that went up here can cost around $100 million. It can cost around 100 to $1 billion to drive this price from here to here. Okay, so what you can see is that at one point price was at this high, and at this particular price, I can see this the high of that candle. If just be looking at distance. Distance here, you can see this is the opening price. So the opening any candle that I place this my crosshair or cursor on, the opening price, high price, and low price and close price will be indicated here. So you can see, as you can see on this candle, you have the high of that candle, which is the head there is 0.6501. So if you approximate that, that's 0.6500. That's a round number. So that's a psychological round number. It's like you want to buy something, you are waiting for price of gas to come down to 500 naira or 1000 naira before everybody start jumping to buy gas now. Okay, you that's a seller, you have gas you want to sell and you hold the gas like people are holding fuel in the filling station now. You hold the price, you hold the gas because you hear that the price might still go up. Oh. You hold it and you're waiting for price of fuel to get to 1000 naira before you start selling. It has to be a round number. It's basically it's majorly a round number. So you can see that this is a round number. And price got the high of that price was 6,500. Just remove that one, 6,500. Immediately price got to 6,500. A lot of offers started coming in. A lot of people started asking to sell. A lot of people started offering their like what they have. So it's like police station now that have been hoarding fuel. Immediately price will go into 1,000. Everybody brought out their fuel. They started offering it to the market for them to sell it out. And that is what happened at this particular candle. A lot of offers came in, and the offers that were in the market at this particular point in price, surpassed the bids that was in the market to drive price up. And you can see the offers dragged that price from 6,500 down, and the close of this candle now is 6,433. So they dragged this down to 6,433. This right here now is a strong indication that the market has been flooded with a lot of sellers. People are willing to sell. People are willing to sell. I can see what happens after this closure. The next day, boom. The next day, boom. Till around this price. What's this price here? Good morning.
I'm greeting you.
Okay, good morning, sir. Someone was interrupting me there. So they drag price to this point. Okay, to this point around 6 to something, and then you can see money came out of the markets. It started to reverse. Okay, it started. This is just like a relief rally from all these things. It's just relief. Yeah. So now the market is now making up its mind whether it wants to do another run to the downside or go up to the upside. So you just all these candles here are just market relations. They are just market relations. What buyers and sellers have done. Okay. So all these things will always remain on this chart. So if you still go back on COVID, when we have enormous price action, like stupid price actions, we still see them on during COVID times. Those were difficult times to trade. Okay. They were difficult times to trade. So all these things will still remain on this chart. So when you go back, you see what happened, how buyers and sellers reacted. So practice, and you get used to this. You get used to this. That when you see them, you just know that a lot of sellers are flooding the market. This is happening, that's happening. Okay. Moving forward, I hope you understand what I'm talking about. So when you go to this site here, it will show you a lot of candlestick formations and what they mean. Okay, on what they can be indicating to you that might be coming in price. Okay, that's why I pasted this link here for easier access. So do your own studies. So now moving on, market conditions. Okay, this is very important to know market conditions. So in the forex market, we have three main three main market conditions. So we have bullish markets. So the bullish market is when the bulls are the ones controlling the market. You have the bearish market. This is where the bears are controlling the market. So a lot of sellers are in the market. A lot of selling is happening in the market. A lot of selling is happening in the market. So for example, during the Ukraine war, a lot of buyers stepped in on gold because gold was gold is actually a safe haven. I think gold is the first currency the world started using. So even from the time of the Bible, they were using gold as their currency. So if there's anything that is to happen, maybe a war or something like a economic breakdown, gold is a safe haven for investors. So that's where investors put all their money so that the money won't lose value because gold will never lose value. Okay, so during Ukraine war, that's wartime. A lot of investors from Russia, Ukraine, all of that, a lot of big banks, they all pumped their money into gold. They just transferred all their money into gold, and you can see if you check during the Russia Ukraine wartime, gold was just going up. Gold was going up. I think gold reached about 2,000 ounce, $2,000 per ounce just during that time, and now it's coming down because everything is stable. Gold have been dropping a lot. So we have bullish markets, we have bearish markets, and we have ranging markets. So ranging market is like a sideways market where the market is trying to decide whether it wants to, maybe when markets have dropped, after dropping it starts ranging. That ranging there is just a decision making time, a decision making point, whether it wants to continue down or it wants to reverse and go up. Okay, it can also happen during the bullish market. You can see this run, bullish market, and you can see here it started to range, and then continued. So most times you can see it range, and then reverse to the downside. So you see there, during a bullish market, price tends to make higher highs and higher lows. Okay, what this means is price will be making a high that is higher than the previous high, which is this. You can see this high here. You can see this high here is higher than this one. This high here is higher than this one. This high here is higher than this one. This high is higher than this one. And whilst it's making higher, it's also making lower highs. Okay. No. Sorry, it's also making higher lows. So you can see this low. This low here is higher than this low. This low 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 is higher than this low. So most times traders look to capitalize to buy when price is trending up. Traders always look to capitalize on price making higher lows to buy into the continuation. Because if you are buying on this high low, this is where you get cheaper prices. They wait for price to come down and they buy below. It's like when they say on BTC, they say buy the crypto. When crypto was running, everyone was saying buy the dip, buy the dip, buy the dip. Now nobody's buying the dip again. So this is like buy the dip. So buy cheaper price and wait for it to go up. Then it comes down again. You buy at cheaper price, wait for it to go up. Buy cheaper price, wait for it to go. Buy cheaper price, wait for it to go up. But this is not going to happen. The problem with people that are buying the dip on cryptos where they just thought that this will continue forever, not knowing that the market is fractal, is manipulated. And now you can see what happened. Everybody now, nobody's talking about crypto again. Everybody has been washed away from the market. So also goes for a downtrend. When price is trending down, it's making higher low and lower low. I mean lower highs and lower lows. It's a bit confusing. So lower highs. This is a high that is lower than the previous high. This is a high that is lower than the previous high, and it will also make a low. a low that is lower than the previous high. So during the bearish market, traders tend to capitalize on waiting for price to retrace. Okay, so this one is like it's not by the dip again. This one is like sell the pump. Once price pumps, you sell. Once price pumps, you sell. Once price pumps, you sell. Okay. So when you sell here, you can look to add positions as price keeps going down, keeps going down, keeps going down. You just be adding position. Just know when to. Just need a trading strategy or an exit strategy that tells you when to exit the market. So most people look to sell from here and then they will exit their sell positions here once it takes out this low, or once it gets a little bit below that low, they take their position and wait for another one. Then most people, you can see most people that do impulse buying, so they are trying to call tops and bottom. Don't look to do this more often, because if you try doing this, you get caught by the market more often. So you see people when price is dropping, they will be anticipating that price will buy from me, price will buy from me, and they will try jumping into the market, into the market to buy. Once they see maybe a green candle like this, they say it's going to reverse, they'll buy, and this thing drop. Doing that is like trying to jump in front of a moving train. It's different from selling from here, because we are on a bearish trend, we are on a downtrend. The market is bearish, order flow is bearish. So buying from here is a lot different from trying to sell from here. Okay, selling from here is like you are trying to go with the trend, but buying from here is like you are trying to stop a moving trend. You see a trend that is moving, you just stand in front of it and try to stop it. You are going to get crushed. Okay, I hope you understand the concept of higher highs and lower highs. Then on the ranging market, there are no high highs, there are no low highs. Price is just going up and down in a particular price range. It's just up, down, up, down. So a lot of traders now will look, when they see a ranging market, they will like to capitalize on this up down movement. Once price is up here, they'll sell from here. And once it's down here, they will close their sales and buy from here. Up here, sell, down here, buy. So that's a strategy you can look to apply. Just do your own study. It's not a holy grail. It's not a holy grail. One thing doesn't work. It has to be a group of confluences because before it can work in the forex market. Okay, here you can see an image showing like a full cycle of the market. So you have up consolidation, down, up consolidation, then price changes. Okay, price changes hands and start going down, consolidation down. Okay, so study your price, so study your charts, and you can get a feel of how this thing looks in real time. So I think I need water. I need water, but I can't leave that. So maybe after this, I'll go get water. So trading sessions. Um, as a trader, you need to know your sessions. You need to know the sections, the trading sessions you trade. So there are actually three major sections in forex trading, and trading as large. So you have here, they say, I put this out there just for your study. You have Sydney section, Tokyo section, you have London and New York section. But these two, this Sydney and Tokyo section, they are both categorized as Asian section. Okay, they are both categorized as Asian section. So what we actually have in the forex market is London section, New York section, Asian section. London section, New York section, Asian section. So we have three sections. So you need to know which section your pair actually moves in. So what this section means is that these are the time that banks open at this at these places. So Tokyo, Tokyo is the capital of Japan. Sydney is the capital of Asia. I mean, sorry, Australia. So once Sydney section starts, that means that's when the banks in Australia are opening. So that's their 8 a.m. in the morning, because here in Nigeria banks open immediately. It's 8. If you have ever been in the bank very early and you are there around 7:50, banks are still not open. Once it's 8 o'clock, immediately they open their doors. That's what this section means. Once is once is the opening of Sydney section, their banks open immediately. That's when their banks open. Once their banks open their door, that's when this section starts trading. Same as Tokyo, same as London, same as New York. But then these two now are categorized into a session because they happen almost at the same time. These are um, countries that are at the Asia that are in Asia. Okay, then you have London section. So this London section actually coincides with Nigerian time. So immediately it's 8 o'clock in the morning Nigerian time. That's when London session starts. That's when the London banks open. They have also New York session. So New York session, that's when the banks in America, the American banks, that's where they open. So you need to understand the pairs that moves at this particular time. Okay, if you are trading, if you want to be trading your session, like for example, people that are living in people that are living in the US to trade London session is a bit difficult because during London session, that is their midnight. That's when they are sleeping. So if you want to trade, if you decide that you are trading the London session, you have to be awake all throughout the night to catch London session. So, but here in Nigeria, we're actually blessed that we sleep during the Asian session. Our prices doesn't really move that much in the Asian session. It does move. It can move. Okay, it can move. It can move very well, but not that often. When prices actually move very well is London session and New York session. And during London and New York, we are awake. And New York session actually closes at 10 p.m. That's when we are about to go to sleep. That's when New York session closes. So we're actually blessed. So here is a an image description that shows trading hours. So this is 24-hour clock. So one, two, three, four. These on Nigerian time zone. Okay, so you can use this as a guide. So moving forward, support and resistance. Support and resistance. This is actually the most common term used in forex trading. So let me check where we are now. Okay, so we're almost at the end. I said I would do this thing in two lessons. I'm actually doing it in one. That's nice. So support and resistance. Support and resistance is the most common term um, in forex trading. So newbies, like when I learned about support and resistance, I thought that this is the holy grail. This is it. I'm going to make money because I know support and resistance is very simple now. It's just to buy a support and sell at resistance. Buy a support and sell at resistance. So I actually gave a very interesting example that will make you understand what support and resistance actually mean. It's very easy to understand. So I actually use the analogy of a floor and a ceiling. So let's say you are trapped in a room now, in a prison cell or whatever, and the room is locked, and you have a hammer, you have the chance of escaping from the ceiling, or you have the chance of escaping from like the floor. So it's either you use the hammer and break the ceiling or break the floor. So that's what support and resistance is actually at. So support means the floor that you are standing on is what is supporting you. So you are standing on that floor. And resistance is the ceiling. That's what is resisting you from going higher. Okay. So let's say now that you get that hammer and you want to escape and you break through the floor. Once you break through that floor, that means support has been broken. You have broken through support. And once you break through support, let's say that room is on the second floor. Once you break through that support, what you're going to get is you're going to jump down to the first floor. And once you jump down to the first floor, you now have a new support where you are standing on. And that resistance, that floor that you broke through on the second floor to now jump to the first floor. Now looking at it, it have turned to what? A resistance. It's now your ceiling. Okay. That's what support and resistance actually is actually about. So on the flip side, if you break through the ceiling, that means resistance broken. So once you break through that ceiling and climb to the third floor, that ceiling that you broke now becomes your floor where you are going to stand. So what that means is that it's like saying resistance broken. And once resistance is broken, that resistance turns to support. Have that in mind. And once support is broken, that support turns into resistance most of the time, unless it's a market manipulation. That's why it's advanced. I'm not going to talk about market manipulations here now. So here there are a few pictures. I actually laid out a few pictures that will help you understand what support and resistance actually looks like on the chart. So there's no need to now go on trading view again to look at that. We actually have these pictures here for this lecture for. But for you, after everything, just go to trading view and start to look for these things. So you can see that we have support. This a support zone is a particular price where a particular price where what is this? Let me say a particular point where price failed to go below for a few amount of tries. So let's say this candle is going up, going up, going up, and it comes down here and it stops here and go back and go start going to the upside again. This place is stopped. This place where price stopped and started going back up becomes support. So if you trap that thing through, you can see that most times price will still come back to that particular level, stop there again and go back up. And then you can see it come back again, stop and go back up. This term of support and resistance can be applied to all time frames, daily time frames, weekly time frame, 5 minute time frame, 4 hour time frame. Any time frame you can spot your support and resistance on all of them. So now you can see resistance price got to this point. It couldn't break above. It came down. Tested support. Got to this point again. It couldn't break above. It came down again. So this is a strong resistance level. And now what you can see now this price came up, broke through resistance, stayed above resistance, and then came back to retest resistance. And now once it has broken this thing now, this resistance now it has broken now turns into what? Support. So now you can see price came back, retested support like it did here, retested support and started going high. And now it's making another new resistance. Come back, retest support, come back, retest support, and now it's broken again. So now resistance is broken again, turn support. So you can also take this on the flip side. Okay, now here you can see this on the actual live chart. So support, support, break, resistance, start dropping. So one of the easiest ways to trade is actually trading using support and resistance. So you can see now this place support, support, and now price has broken through. What will be if this is actually a downtrend, because I've already talked about the trend. If price is bearish on like the overall basis is bearish, like you can see there when we talked about um types of market condition. If price is bearish, what a lot of traders will be looking for is you have this price here, support, support, then they draw a line, meaning a support line here. Now you see support is broken, and you can see price came back to that support, and you see this, and you see price. What's price at that support? You see this candle formation here that signifies that bulls like a lot of bids came into the market, but then offers just came back to the market and closed price below the support. This is a very good place to sell because now you have a bearish trend, you have an area of support that has been broken. You have price coming back to it as resistance, and now you have candlestick formation indicating that okay, buyers tried to step into this market and sellers came back and pushed it back down below support. This is a very good area to say. You can see price sold off. Okay, it's very easy, but it doesn't always work. It doesn't always work this way. But because this is a very good strategy to trade. Very, very good strategies to trade. You don't need smart money, markets overloads or whatever to trade. You can make it this simple. Also, you can see here now. So this is where it's actually more complicated. You can see resistance broken and came back as support. Let's say you bought here now. This thing went up and you're still using your trade. It can still come down, test again, test again, test again, and it started going up. Okay, these two are like real charts examples. Okay, hope you understand that. Then moving on into chart patterns. Chart patterns. So chart patterns are key components of technical analysis in trading and investing. So they are visual representation of historical price movements on a chart and are used by traders to identify potential future price direction. Chart patterns can be broadly categorized into two types: continuation and reversal. Okay, continuation chart pattern means that these are patterns that will indicate, let's say price is trending down and you have a retracement, like what I explained here on the downtrend, you have down, retrace. Most of these retracements that comes up here, if you check all the if you look at the chart pattern that we are going to look into, this this retracement is actually a chart pattern. It's actually a continuation chart pattern that will continue price to the downside. You can also see one maybe a continuation. Then also for bullish, you can see up retracements. If you check the chart pattern, you can see something that might look like this, or something that might look like this, or something that might look like this. So let's go. These chart patterns will indicate whether price wants to continue or price wants to reverse. Okay, you can read through all this. You can read through all this. So let's just go straight to the image here. So you can see these ones are reversal chart patterns. So what this reversal means, like if price is trending to the upside, price have been trending, and it gets to a particular level of resistance or a particular price point, like I told you when I was explaining that candlestick, you have price get up to 0.6500, 500 round number is a round number. So if you now that I did show you that on a daily time frame. So if you can go back to that again. So, I did show you here on a daily time frame. So you can see this says 500. Let's put that on 500 on a daily time frame. So if you can go down to like 30 minutes, you can see that particular price there. So you can see here, this is 500. 500. That's yeah, this is where the daily candle started. This the high that daily made before it started going down. So now, if you go back to this, is actually a very good example. If you go back to chart pattern, this is a reversal pattern. This means if price is trending to the upside, if you see any of this pattern at a good level, not anywhere, because you can just the price can just be trending and you just see this chart pattern. You can see it's going down, and you see a reversal. You take a reversal and still keep going up. You have to see it at a good level that have other confluences. It's not going to. It doesn't have to. It shouldn't not. It doesn't. It shouldn't be only one that you're just looking for double top. So anywhere you see double top on chart, you start try to sell, you're going to get wrecked. Okay, just need a combination of confluences. So here you can see the first one is double top. Okay, a lot of traders actually use double top and double bottom. So double top is when price is trending up and it's about to reverse. It makes a double top and then reverse. Double bottom is when it's trending down. Before it reverses, it makes a double bottom and reverses. It doesn't always make a double bottom and a double top, but these are like the easiest ones to spot. You have a head and shoulder, so you have something that looks like a mountain. So you have right shoulder, head, left shoulder, and reverse. This one is on the flip side if it's trending down. All these ones here are if price is trending down, and all these ones are if it's trending up, I want to reverse to the downside, and this one if it's trending down, I want to reverse to the upside. So now let's take this double top as an example. From what I explained on that chart, that price went up and reached 6500 and reverse. So you can see now on 6500, what do you have? You have a double top. You have so you can see now. You can see on this thing you have one, two, three down. Okay, that's a double top. And if you look at this thing here, it's the same thing. Okay, the same thing up, down, up, reverse. That's what you have here, a double top. And also on the second shoulder of that double top, what do you have again? You still have this is a doji candle. So from that link I pasted on that material that you check it out, you see this candle, this is actually a reversal candle. So what's happened is that price was dragged up by bids and offers came in and pushed back and pushed price back down to this level and it started to reverse. So this is a good example of a double top reversal. I don't know if I can see a double bottom. Okay, here you have down, up, double bottom, up. But it has to be, you have to coincide with other confluences. You don't just buy because you're seeing a double bottom. Here, this is actually a double bottom. So a double bottom doesn't have to be straightforward. This, like also like this double top, it doesn't have to be straightforward. It can be, this can be up here, and then this one is like around here. It's still a double top. It just needs confluences, other things. Like this one is a double bottom here. Okay. So moving away from that, so yeah, all these are reversals. So you can check that out on on your own. You can check it out. I can't be looking at all these things. So I've already given you an example of this. Look for this, look for this, look for this, look for this. Okay. And these ones are continuation patterns. So these ones are continuation. So you have the bearish bullish flag. So this bullish flag indicate that price is going up and start to retrace a bit, and then it's gonna continue. Let's go to the chart and see if you can find okay, you are going down on this one from here. We already made this high and we're coming down. So this is actually this here now. It's actually a bearish flag. You can see this is a continuation pattern. So it's went down, retrace, breaks this flag, continues. Okay, so that's one there, and another one. This is actually a bull flag. So up, down. So if you use this analogy here now, this is a flag, down, breaks out and continues. Okay, that's for continuation. And you have these ones here. You just look at the chart and study the charts, and you find these things. Okay, you find these things. So my recommendation is here is do well to study your chart and see this happening on real price chart. Take notes and take notes. Take a lot of notes. Even when you're doing this, take a lot of notes to aid your learning curve. Okay, I have to put in the work. So going on. Since this is the last for this part of this part of the lesson, advanced part one. So types of traders, very important to know the type of trader that you are. So in forest trading or anytime you have forest trading, you have stock trading, you have crypto trading, all of that. So you have a few types of traders, and what you have from here, I think the material or already have explained has explained the whole thing. So I don't need to go deep into it. Just read it and you understand what's going on there. You have day traders, you have swing traders, you have position traders, and you have scalpers. So let me start from scalpers. Scalpers are are traders that actually make use of the smaller time frames. Scalpers, I think the highest time frame scalpers can use is the 15 minutes time frame. So scalpers trade anywhere from the 20 seconds time frame, 30 seconds time frame, 1 minute time frame, 5 minute time frame. That's where they trade. So they look to capitalize on small market movements. So actually, scalpers trade only during sessions. A lot of scalpers actually trade just New York session because that's when a lot of volatility is coming to the market. That's when the market is moving really fast. So they need to capitalize on small price movement. So once price move from here to here, they just enter immediately. Take price move a little bit in their favor, they close their trade. So these scalpers use high leverage. So they use high leverage just to gain a lot of profit because small price movements actually won't give you a lot of money. So but with leverage, scalpers actually use huge loss sizes to enter and exit the markets quickly just to make money. Then you have day traders. Like myself, I'm a day trader. So day traders are for us, we don't actually deal with anything that is for me, anything that is lower than the 30 minutes time frame. I don't use them. So day traders are actually they are not that fast. Okay, you have to understand your own personality, your own characteristics. Are you a fast thinker? Are you if you're a very fast thinker, you can interpret information very fast. Then you can do scalping. I cannot interpret information very fast, so I need a lot of time. I need it to be slow. I need a lot of time to process information. That's why I'm a day trader. So you can take like anywhere between one trade or two trades a day. Whilst a scalper can take like 20 trades a day, 20 trades, 10 trades in a single day. Okay, then you have swing traders. So these are swing traders, people that take long-term positions. So a swing trader can take anywhere between 2 to 3 trades a month. Okay, for day traders can take anywhere between 2 or 1 trade a day, and then around 4 or 5 a week. Swing traders can take like 5 a month. I think max five, unless they are trading a lot of pairs. If a swing trader is trading like a single pair, he can take like 1 or 2 trades a month. So these are people that take trades and hold for a very long time. So these people are not are very slow thinkers. They need time to process information, and they are maybe maybe there are people that are fast thinkers, but they have other things doing. So if you are a student, if you are working your job, or you have other things, you are very busy, you can opt for swing trading. So you can just look at the markets once or twice a week and just take positions and hold them for a very long period of time, maybe a week or 5 days or 3 days before your trade can hit your targets or hit your stop loss. Then you have position traders. This one are mainly big banks and institutional investors. So they just bet that maybe, or from what I explained there on this thing, you can go back on trading view. So on 12-month chart, on the 12 monthly chart, so on the 12 monthly chart on this Aussie dollar, so you can see, so maybe a swing trader now can actually bet on this. You have a huge down bar on Aussie dollar, and you can all these swing traders, they actually the ones looking for long term economic events. So they might look at the news and see that euro is getting strength, that this is happening, unemployment is gaining weight in Australia, this and that. So with this, they've already know that the last 12 months on Aussie have closed bearish, and with all the news and everything coming out on the internet, it's suggesting that um, Australian dollar is going to get a lot weaker than it is now. So what they can do is this candle now, this particular candle it's actually a full year. 1 year, it takes 1 year to form. So what they can do is that they'll just look for, let's go on the 3 month chart, you just look for anywhere that price can maybe do a pullback to the upside, and they will sell from anywhere from here. They'll just sell. Okay, they can spot the opportunity from the yearly time frame. They'll go to somewhere, maybe they're like the weekly time frame. Okay, they go to the weekly time frame and look for opportunities and chart patterns as price is going up. And once they see a chart pattern also, maybe like something like you have this, and then you have this candle here. This thing is actually shooting star. This is a good sign to enter. So you have price was driven up by bits, and the offers came in and close price below. So this is actually 1 week. So they can see this now and say, okay, price is ready to go, and they sell this thing from here. Okay, they will sell from here, have their stop loss somewhere. This is a very wide stop loss, like a one almost 200, 500 pips stop loss. So they use their risk. They know how to analyze. They use a particular risk parameters, so they don't lose a lot. So these people are actually swing traders are actually the ones that makes a lot of money. But you just have to be patient. If you can be patient as a swing trader, you can make a lot of money. So now you can see price started dropping. So each of these candle are a weekly can a week. This is 1 week, 1 week, 1 week. So you can see before price dropped from here to here. These are what like 5 months. Okay, imagine holding a single trade for 5 months. Okay, so that means let's say you have in your account you have $500 or $1,000, and you decide to enter this position. Okay, once you enter this position, you should be risking anywhere between $200 or 500, or just half your position, because you know that you only take trade once. You only take a trade once, or you just take trades once in a month. So you just reach like $500, and this thing start dropping, and here it retraced a bit, and you see an opportunity to enter again. You can move this to break even. That means this trade is risk free, and you enter in again for another $500, and just drive, keep driving price based on what you know that is happening around the world, not based on technical analysis again. Because just technical analysis cannot sustain this. Okay, you need other things, you need other confluences just to sustain it, economic factors, and then you have technical analysis to it. Because as you can see now, I did add technical analysis to this, and also on the 12-month time frame. Okay, that's what position traders actually do. They hold trades for a very long time, a very long time. So I also have other types of traders, algorithmic traders. These are just traders that use, okay, they know how to program. They just program their trading style into computers. So like banks actually trade with algorithms. They don't have people sitting there to push buttons enter position. They use computers to do that. And other ones, event driven traders. So read through it and you understand all this. So now this is the end of advanced part one. So the next video will be on advanced part two. Hope you got the information I was trying to give out, and then take notes, study your charts very well, and just don't let your money go to waste. It's actually small. It's actually small. A small amount of money. This what I'm teaching you is actually what a lot of people pay 300,000 in this Lagos to learn. So it's actually you're just paying. You're basically paying nothing. So put in the work because you're getting this for free. You're getting it for free. So on to the next one. See you guys.